Hi, what's up? I'm Brandon. So how much cash do you actually have to come out of pocket in order to buy a house? And are there ways to reduce that amount? I'll be answering those questions today in this video and also providing a few real-world examples. I know it's disappointing for most first-time home buyers to hear, but you're going to need enough cash to cover more than just the down payment. It's better to know what to expect now, rather than getting to closing and realizing that you don't have enough cash to cover closing costs. The biggest and most obvious cash expense is your down payment. And I'm sure most of you have heard the 20% rule of thumb for the amount that you're supposed to put down for your down payment. This is because buyers who put down less than 20% of the purchase price are required by lenders to pay for private mortgage insurance, or PMI, which is an additional 0.5 to 1% of the purchase price every year until you reach 20% equity in the property. Depending on your income and credit score, some lenders will let buyers put down 15%, 10%, or even 5%, but of course your monthly mortgage payment will be higher, and you'll have that PMI that I mentioned earlier. Those who qualify for an FHA loan can put down as low as 3.5%, but you also must factor in a mortgage insurance premium of 1.75%, which is due at closing. And military veterans who qualify for a VA loan can actually finance 100% of the purchase price and have zero down payment. The next cash requirement, which must be factored in, is your closing costs. Closing costs vary state by state, but they include things like appraisals, title insurance, loan origination fee, and any points paid to lower your mortgage interest rate. Closing costs typically come out to be about 2 to 3% of the purchase price. If you can't afford to pay your closing fees, many lenders offer what's called a lender credit, where they give you cash towards closing in exchange for a higher interest rate on your mortgage. That's actually what my wife and I ended up having to do on our first house because we were just not prepared for those costs at closing. Luckily though, a couple years later we were able to refinance and get that interest rate down to a reasonable rate. Many lenders require that you prepay your property tax and home insurance at closing. They call this an escrow account, and they typically collect between 1 and 12 months of those expenses up front. Lenders also want to see that you have cash reserves. By this, I mean that lenders want to make sure that you have cash left over after the deal is done as a safety net. This cash will stay yours and it does not go towards closing at all. So now let's go through a couple examples with different down payment amounts. So let's say for all of these examples, you have a $400,000 purchase price for your home. For a 20% down payment, you would be putting down $80,000. There would be no mortgage insurance premium. Your closing costs, which are usually about 2%, would be $8,000. You aren't taking a lender credit here, so you're not getting any cash towards your closing costs from the lender. Your escrow, which is your 6 months prepaid property tax and insurance, is $2,000 for a total of $92,000 cash out of pocket at closing. In this case, your interest rate would be 3% and your monthly payment would be $1,349 with a PMI of $0 because you put down that 20%. In option 2, you'd be putting down 10%, which would be a $40,000 down payment. Your mortgage insurance premium is still $0. Your closing costs are $8,000. In this case, you're going to take a lender credit of $7,000 towards closing costs. Your escrow account is the same at $2,000. And your total after lender credit is $43,000. Now because you took that lender credit, your interest rate has increased to 3.5%, resulting in a monthly payment of $1,616 a month and a PMI of $200 a month. And in option 3, we have an FHA loan with a 3.5% down payment, resulting in $14,000 cash out of pocket for the down payment. Your mortgage insurance premium for an FHA loan is 1.75%, which is $7,000 on a $400,000 purchase price. Your closing costs are the same at $8,000. You're not taking a lender credit here. And your escrow is also the same at $2,000, totaling $31,000 out of pocket, which is actually more than double the down payment of $14,000. Your interest rate on this FHA loan will be 3.2%. Your monthly payment will be $1,669 a month with a PMI of $300 a month. So I hope this video has given you an idea of how much cash you're going to come up with out of pocket at closing, so there aren't any surprises when you go to buy your first home. If you like this video, please give it a thumbs up, and if you want more content like this, please subscribe.